think what we learned in sort of the debt ceiling issues a week and a half ago, which will come back again in the spring and into June, is that the Republicans aren't going to fall into line on every single issue. And frankly, when you think about it, most of policy in a House of Representatives where, by all rights, before these special elections, the Republicans may only have sort of a 1 or 2 seat majority here, everything is going to be a struggle. And in the end, that may not be a bad thing, because part of what we think the governor of the amount and forcefulness of the policy that Trump can and will deploy is based on the bond market. And the bond market does not like the concept of sticky inflation. And the bond market does not like the concept of a level of spending and indebtedness that continues to go on its current trajectory. So there is going to have to be some compromise in policy as we go through this year.
Julian, you got 6,800 on the S&P by the end of the year. I hate to sound like a perma bear, but I will. What could go wrong? And this is a historically expensive market, isn't it? Trading at 21, 22 times. Isn't it just too perfectly priced, given the balance of risks and given that we will only really know just the real contours of Trump's economic policy after January the 20th? Isn't this a market that's getting just way ahead of itself?
So, Sri, this may sound counterintuitive, but in the logic of the markets, this will make sense. Literally everything can go wrong, okay? From policy mistakes to overshoots in yields, overshoots in the dollar. The one thing that we don't see going wrong specifically is a significant downturn in the U.S. economy, which tends to be the thing that really makes markets this expensive vulnerable to material setbacks. From our point of view, the biggest challenge straight ahead is the fact that if you look back this entire bull market cycle, when you get yields above 4.5%, on the 10-year, the market tends to get queasy. That's what we've seen over the last 4 to 6 weeks. When you get over 4.75%, which is why the data over the balance of this week, particularly the employment report on Friday, is so very important. Over 4.75, you can expect a bigger pullback. And to us, the real issue here, and this is where we think policy gets dialed back or maybe more appropriately fitted to the environment, over 5% in the 10-year yield is where the bull market thesis and our view of 6,800 would likely be challenged.